today's webinar on holding insurance in a self-managed superannuation fund. So this is going to be fairly fast-paced webinar because there's certainly a lot of areas that I want to cover off on. It's a subject matter that I've spoken a lot about over my many years in the SMSF industry, because it's clearly one of those areas that, you know, in the very early days, very little was held in the way or by way of superannuation or by way of insurance in self-managed superannuation. And of course, we've then subsequently had legislative changes and regulatory requirements where we have to consider insurance. And so when we consider insurance, we then have to work out what we're actually considering. And you know, over the journey of that time, there's been multiple strategies that have been proposed and ultimately accepted and then subsequently rejected. And so it's a little bit of an opportunity, I guess, to identify where there are some traps in that as well to be mindful of. So what we will do is work through it. As I said, it'll be relatively quick paced on a number of issues, because I suspect that many of you will be on top of the basic requirements. But if you've got any questions along the way, as always, chuck them in the Q&A box there on your screens, and I'll endeavour to answer them. If we can't answer them in the session, then I'll make sure, as always, that I put an answer in when we send out the CPD following the end of the session. And just because one of the normal questions that I get is will we be sending out a copy of the presentation? Absolutely, you'll get a copy of the slides. And what I've tried to do where appropriate is put the regulatory reference, so the various acts, put the section references there, because a lot of this stuff you find yourself chasing your tails trying to find where it is within the law. So hopefully I've been able to provide that for you within the material. So what we want to get out of today is when insurance premiums are deductible. So under what set of circumstances we can claim a tax deduction in our fund. Key differences between temporary and permanent incapacity insurance and benefits. And look, I think that's a key issue, and certainly and I know that a number of you online at the moment I've spoken to about various insurable events in the past, and you know we talk quite regularly in this industry about death benefits. I think we talk less so about disability benefits, and I think it's an area that as we have an aging SMSF population, we certainly need to be more in tune with what that means from a super fund. And whilst I'm not going to venture down the path of enduring powers of attorney and the like today, you know, it's one of those critical matters that whenever I talk to people about setting up a self-managed super fund, not from an advice piece, but from is an SMSF the right vehicle or the right structure, and we talk about fund establishment. Well, I know many of you now will engage with people and say, okay, you've got to set up a deed, but have you got a will in place? Have you got yourself an enduring power of attorney? Because in itself, it becomes quite a critical document, particularly if that disability is one of mental nature and somebody loses capacity. Then they might want to be retained as a member of the fund to receive a disability benefit, but they of course can't act as trustee of the fund. So you have to deal with that. So that's a whole subset of other matters that needs to be contemplated beyond the idea of having insurance in the fund. But definitely a massive difference between temporary and permanent, not only in the benefit payment side of things, but also, you know, how you're structuring the fund around it, and what other elements that need to be factored in, such as a transfer balance cap. The use of the future liability to pay benefit deduction. Look, this is just me regurgitating what I've regurgitated for 20 years, in the sense that this idea of specific pre-age 65 tax deductions that almost exclusively, it's not fair to say that they are exclusive to self-managed super funds, but they almost exclusively can apply in the SMSF environment. And the beauty of it is that we don't necessarily need to act other than to consider insurance, but it's a good one to have in the back pocket for when we're discussing certain issues with clients in the event that something happens to a member pre-age 65. So I always like to go back over the future liability to pay benefit deduction, but then also the caveat of that and any of these insurance-based deductions is with death benefits and non-tax dependents, we have to contemplate the untaxed element as well. So I work through an example all of those sorts of issues. So disability benefits, future liability to pay a benefit deduction, as well as the untaxed element. I'll work through all of that within the presentation. And then ultimately, I will finish off by summarising a couple of the investment-based insurance requirements, but also just other considerations around insurance, such as holding insurance inside a pension interest and what the ramifications are from say, an interest allocation, ECPI, and other things as well. So let's jump into it. So, almost a stock standard sort of opening is that SMSF is a powerful retirement income and estate planning vehicle. So realistically, we spend a lot of time talking to people about what's going to happen when the member passes away, and theoretically what happens if the member becomes disabled, how or who is going to receive, how the benefit's going to be paid, who are they going to be received by, can the benefits be recontributed to the fund, and strategically this whole concept just broadens itself even more with the removal of the work test pre-age 75 and the capacity for I guess members to continually contribute up until that point. So historically, when we looked at the idea of a death benefit payment and the capacity to recontribute that amount, subject to the age of the member, if they were ultimately previously over 67, well, it was a fait accompli that there was no capacity to put that money back in. But if we've got somebody where the spouse is under 75 now, and they're nowhere near their transfer balance cap, and if we're talking $1.9 million, that is going to be a fairly significant proportion of our industry post 1 July this year. Well, then do they have the time to make contributions back into the fund after the death benefit? And then subject to the age of the deceased, is there benefits of some of these deductions associated with it? So, what we need to talk about in this space is not just the taxation of the benefits to the beneficiaries, but also the taxation implications of holding insurance inside the superannuation fund. So what benefits can the fund itself also get out of these strategies? So we're really looking at all of these strategies for a long-term benefit, as in, why are we undertaking, or what are we doing from an estate planning point of view? What are our trustee obligations? What are our fund strategies with multiple family members? And I'll touch on that a little bit later. But also, what is the taxation impact of holding this insurance inside the superannuation fund versus holding the insurance outside a super fund? And that conversation shouldn't always just be about deductibility versus non-deductibility. So it should be a little bit more about who those beneficiaries are. So if somebody doesn't have a spouse and they only have non-tax dependents, then is it valuable to them to hold their insurance inside the superannuation fund if, particularly due to their health, there's a greater likelihood that they're going to pass away pre-65 and therefore have the untaxed element that I'm going to talk about? So all of these things form part of the big, broad conversation about insurance inside a self-managed super fund. And of course, adding into that the transfer balance cap, and that becomes a real conversation piece around one of my favourite subjects, as many of you will know, which is reversionary pensions versus non-reversionary or discretionary pensions. And I'm never afraid or ashamed to talk about my preference from a flexibility point of people having discretion to determine what is possible to be done on death. So rather than locking something away as a reversionary pension. But if you want to know one area where it's absolutely crystal clear that reversionary pensions are better than discretionary pensions, it's when there is insurance associated with that member's interest. But the offshoot of that is how many reversionary pensioners still actually hold insurance inside their superannuation fund. So, just because it's an absolute gold standard reason to have a reversionary pension, we've got to actually reflect back and say, but actually, do they hold insurance when having that conversation? So it's really about collecting all the information and working out how insurance fits in. So these are the subject and the talking points, I guess, that I want to conclude with today by going through the various key issues associated with holding insurance inside a self-managed superannuation fund. So let's start with the regulatory part of it. So let's be technical for a moment before we get practical, and let's identify that Ultimately, we operate under two sort of guiding principles, and that is that the fund is operated for the purpose of the sole purpose test. So we're operating to provide benefits to the members, provide benefits to the member on retirement or attaining age 65, or we're providing benefits to the members' beneficiaries if they happen to die before they retire or turn 65. So that's a link into the need and the requirements of insurance with the sole purpose test. We then have the ancillary benefits, which is the payment of benefits post retirement, post age 65 to the members and beneficiaries. So estate planning is and the retention of money inside a superannuation fund for beneficiaries post age 65 is an ancillary purpose. So it's not the primary reason we have our fund operating. But then in addition to the sole purpose test, we have the operational element of the fund, and that is that the trustees are under the guiding principles of the operating standards as identified in section 31 of the SIS Act. And then section 34 effectively imposes through the regulations penalties on trustees that don't adhere to the operating standards as identified in 31.1. Now, those operating standards do talk about a couple of issues, one of them being insurance and another one being the investment strategy of the fund. And from 1 January 2023, so some people may have missed this prior to the Christmas period, but our penalty units increased to $275. Now, obviously, a big part of what we will try to do is avoid having penalties provided to our clients, or admin penalties associated with our clients for any administrative issues. But a breach of the operating standards, which is ultimately a breach of the benefit payment standards, the contribution standards, the investment strategy standards, and so many more other broad elements. If we breach that, it can cost each trustee $5,500 based on the current penalty unit. So what we have to understand is, what do the regulations require us to do? So the extract from SIS Reg 409 about investment strategies is that the trustee must formulate, review regularly, and give an effect to an investment strategy that has regard to the whole circumstances of the entity, including, and of course I haven't put it all in here, but whether the trustees of the fund should hold a contract of insurance that provides insurance cover for one or more members of the fund. So I guess the key point to that is, you don't have to have insurance inside a self-managed superannuation fund. You have to review and give effect to an investment strategy that has considered whether or not insurance should be held for the members of the fund. So what you've ultimately got to do then is make sure that your fund's investment strategy, however broad or narrow it is, makes reference to insurance. And I certainly know from an audit point of view, in not only my conversations with the auditors that we use, but my conversations with auditors over my history of time, is that since these regulatory changes came in and around 2014, or whenever that actual time was, might have been a little bit earlier for that one there as well, it's certainly a question that auditors will look at or will ask when they're reviewing the fund's investment strategy. So all they want is a statement to the effect that the insurance has been considered. And so once we've got to that point of considering insurance as part of the investment strategy, we've also got SIS Regulation 407D, which identifies the permitted types of insurance that we can hold inside a fund. And those regulations are also quite specific, is that trustees must not provide insurance benefit in relation to a member unless it's consistent with conditions of release 102, 102A, 103 and 109, which is death, terminal medical condition, permanent incapacity and temporary incapacity. So this was a regulation that was put in place from 2014, and later on in the presentation I will highlight some of the rules around those pre-2014 insurance policies that might be held. But ultimately what it's saying is, you cannot hold insurance on behalf of a member unless it's a policy for death, terminal medical condition, permanent incapacity or temporary incapacity. Now, I will go through probably the more critical of those definitions, which is the permanent incapacity one. I'll touch on that shortly, as well as temporary incapacity. But really, what it's saying is, okay, once we know that we can hold these policies, then what is the benefit, if any, to the fund by having them under those purposes, and the benefits normally extrapolated via the Tax Act. So, again, I've been doing a lot of work recently on contributions, and the SIS Act really tells us when can a fund accept contributions, right? And that's all it tells us. This is when we can accept contributions. The Tax Act then tells us what are the pros and cons of how much you put in. Like if you put in too much, here's your excess contribution regime. Here's all your exclusions to the various caps. Here are your caps. Here's your bring forward rules, all those sorts of things. Well, the rules are the same when it comes to insurance as such, and that is that the SIS Act prescribes that we can hold particular styles or particular types of insurance inside our fund, and then the Tax Act guides us on what benefits we might get by having such insurance. But not only what benefits, what are the taxation ramifications associated with having insurance and then paying out benefits linked to that insurance. So our primary source of information about insurance and deductions subject to insurance is section 295.465, and this is our deductions for insurance premiums. So this is the deduction that most, if not all, funds will use on an annual basis to claim their monthly or their annual premium that they're going to pay off to their insurer. And I'll touch a little bit on the concept of monthly versus annual as well, because it's an area that can potentially lead to problems when we're talking in regards to, say, the future liability to pay a benefit deduction. But regardless of that, it is our most common type of deduction, and it ultimately reduces the tax that the fund pays. So the normal way that this is conversed is that you put in a contribution, or you make an employer contribution, the fund pays 15% on that contribution. You actually pay an insurance premium, so you're offsetting the tax on the contributions. That, in a roundabout kind of way, is the concept behind contributions being offset by insurance premiums. But ultimately, the insurance premium offsets any of the taxable income of the fund from a deductibility point of view. The purpose about linking it to contributions is that if you're not having contributions being made into your fund, then those insurance premiums are actually eating away at your member benefit. And where does that sit in regards to things such as the sole purpose test, as far as providing benefits to the member? Is it valuable? Is it worthwhile? And it's something that the fund should need to contemplate. And then our second insurance-based deduction is our deduction for the future liability to pay a benefit. And this is only available, as I said in my introduction, if the member is under age 65. And there are other conditions, and we will work through those conditions. So there was, prior to all of this, of course, our anti-detriment benefit, where in the payment of a death benefit under certain circumstances, we could effectively almost refund the tax that had been paid over the lifetime of the fund as part of that death benefit. That anti-detriment requirement was removed back in 2017. So, I'm going to touch a little bit on self-insurance reserves. Well, there are funds out there that would have had reserves for self-insurance and for anti-detriment purposes, and those reserves are ultimately now just a general fund reserve. And any fund that's sitting there with those reserves should be contemplating, ironically, as part of their investment strategy as well, how those reserves are managed and ultimately allocated. Because, again, holding reserves inside a fund without any real purpose is somewhat, anti-sole purpose test. And the tax office have released a bulletin about reserves previously, which covers off on the reasons why a self-managed super fund should hold reserves. And ultimately, their answer is there is no reason other than for defined benefit pensions. There is ultimately no other reason why a self-managed super fund since 2017 should be holding money in a reserve. So something to be mindful of. But again, that's a subject for another day, another session. And again, with these deductions for insurance premiums, we then have to be mindful of what the implications are from a taxation point of view, so the untaxed element. And then the link back to the SIS Act is that to be entitled to claim a deduction under these various sections, then our benefit must be a death benefit, a benefit payable because of terminal medical condition, a disability benefit, or a superannuation income stream payable due to temporary disability. So again, we then have our link between the SIS Act and the Tax Act, in that the SIS Act prescribes we can only hold insurance for particular benefits, and the Tax Act says, and you get a deduction if you hold premiums or you pay premiums from your super fund for insurance policies that pay out under those conditions of release. So there's the link between the two acts. The thing about disability benefits is they're quite prescriptive and quite distinctive, and we need to understand what we're talking about in regards to the payment of a disability benefit. So let's jump into superannuation and disability, because we've got two things to be mindful of. We've got temporary incapacity and we've got permanent incapacity. So these are our conditions of release, Schedule 1, Condition 103 and Condition 109. So 103 is the permanent incapacity condition of release, where there is no cashing restriction, versus temporary incapacity, where I'll touch on what the cashing restriction is in a moment. So, you know, if I just go and read this out as it currently stands. So temporary capacity in relation to a member who has ceased to be gainfully employed, right? And then you've got your little bit about temporarily ceasing to receive income, means ill health, whether physical or mental, that caused the member to cease to be gainfully employed but does not constitute permanent incapacity. So ultimately, whatever your condition is, it's not one that will stop you from working forever. It will just stop you from working for a short period of time. And the link being to income protection policies. So, you know, whether you take out a policy up to, you know, 2 years, 5 years, up to age 65, there are various policies out there, and you're basically going to be paying your premiums based on the sort of benefit you're choosing to have. So a shorter term policy is going to have lower premiums than a longer term policy. But of course, we know that temporary incapacity already incorporates the definition of permanent incapacity. And so what is permanent incapacity? That the trustee is reasonably satisfied that the member's ill health, physical or mental, makes it unlikely that the member will engage in gainful employment for which the member is reasonably qualified by education, training or experience. Now, this is a difficult one in the broader scheme of things, because the Tax Act is more implicit on what it requires for a disability benefit, and I'll touch on that in a moment, versus the SIS Act and permanent incapacity. And what I mean by that is that both these conditions of release are reliant on the trustee's interpretation of the member's condition. Now, what we ultimately have here is a self-assessment of our own health to access benefits from a SIS point of view. Now, that is quite a dubious way to go about things, and so in many respects, I think it's very important, if not critical, to be far more reliant on the taxation determination or the taxation definition of a disability benefit before contemplating permanent incapacity. And similarly with temporary incapacity, it's really going to be, would your insurer pay out under an income protection policy to determine whether or not it's possible to access benefits for temporary incapacity purposes. And ultimately, most of the time, people are only going to be able to fund a temporary incapacity benefit if they have income protection. So I'm going to come back in a moment, and I'm going to distinguish between permanent incapacity and the disability benefit as well. But from a temporary incapacity point of view, we've got our condition of release and our cashing restriction. So permanent incapacity, zero cashing restriction, right? If you are unable, if you're unlikely to ever again be, or ever, and sorry, not again, ever be gainfully employed, that's a Freudian slip there, because the word again used to be part of the legislation, which implied that to get permanent incapacity, you had to cease work to be able to access the benefit. Whereas now they removed that again, and then it just talks about your capacity to ever be employed based on your current training, education, etc. So the capacity or the condition of release and the cashing restriction is that under temporary incapacity, you can pay a non-commutable income stream for the purpose of continuing in whole or part the gain or reward which a member was receiving before the temporary incapacity. So all of you would know it. If you've got clients with income protection policy, then that income protection will only pay out a certain amount. Often it's up to 75% of the member's salary, but there's nothing to suggest that from a super fund point of view, it has to be 75%. So you can, in theory, pay up to 100%. of the gain or reward that you're receiving before the temporary incapacity, and for a period not exceeding the period of incapacity from employment of the kind engaged in immediately before temporary incapacity. So critical thing, you had to be working, right? Now that as an employee or as self-employed, but there had to be a working element for you to be able to access the benefit there. Then it gets quite technical, because you go, okay, well, this tells us that we can pay a non-commutable income stream from our superannuation fund for the purposes of temporary incapacity. So, hey, I'm on sick leave, I'm just going to start to withdraw money from my super fund. Well, not so quick on that, because we then have our minimum benefit regulations, and Div 5.2 and 5.3 of the SysReg outline all of these elements. And our minimum benefits for an accumulation fund, which all self-managed super funds are, is all the members' benefits in the fund. Now, taking that a step further, there's this quirky rule, and this will all make sense in a moment, which talks about all employer contributions that are received by a superannuation fund are mandated employer contributions, unless they're not. Now, that sounds odd, but basically as trustees, you have to determine, or you have to assume that all employer contributions in the fund are mandated employer contributions, so under an award or under the super guarantee, unless you've got evidence that suggests that they're not mandated contributions. So that's important, because when we then talk about the temporary incapacity benefit and the minimum benefit rules, it says our minimum benefits must be maintained until they're cashed as benefits other than temporary incapacity. So really what the SIS regulations do is they stipulate that from a condition of release under temporary incapacity, we can access a non-commutable income stream from the fund, but under the minimum benefit requirements, it says we can't use our minimum benefits to fund that commutable or that non-commutable income stream, with the exception of benefits that are not member or mandated employer finance benefits. So if I put all that together, what does it mean? It means that if you've got employer contributions going in that are mandated, and if you've got personal contributions going into the fund, then those contributions and the earnings on those contributions cannot be touched for temporary incapacity purposes. If you've got salary sacrifice or non-mandated, so your employer just pays over and above the award on your behalf, then those contributions are non-mandated and they are a carve out from the minimum benefits, so they could go towards funding a temporary incapacity benefit. But from an administrative point of view, administrators will largely make the standard assumption in accordance with those regs that all contributions from an employer are mandated, right? So you need to be able to identify and put on record that certain amounts are not mandated, so that in the event of temporary incapacity, the benefit could be paid out as a non-commutable income stream. So these temporary incapacity benefits are ultimately primarily funded by income protection insurance policies, and it's not an income stream for the definition of a pension, so there's no ECPI, so it's pretty much a self-managed super fund paying a temporary incapacity benefit is ultimately a means for the fund to claim a tax deduction on those income protection policies that the member is actually otherwise entitled to claim externally as well. So often temporary incapacity in super is a means of being, is a cash flow decision, right? So then you've got to argue, well, is a temporary incapacity insurance policy inside a super fund, is that a sole purpose test issue or not? Because if the tax benefit's going to be the same inside or outside of super, why am I holding it inside of super? But there are potential benefits there. So that's where we need to be mindful of with temporary incapacity. If we move on to permanent capacity, then again, what I highlighted before was that we've got the trustee being reasonably satisfied, but that not, in my opinion, being a high enough standard to hold the trustees to. So we look at the definition of a superannuation disability benefit, and it talks about a benefit payable to an individual because he or she suffers from ill health, physical or mental, and 2 legally qualified medical practitioners have certified because of the ill health, it's unlikely the individual can ever be gainfully employed in a capacity for which he or she is reasonably qualified because of education, experience or training. So other than mixing the words experience or training around in the sentences there, the Tax Act and the SIS Act now correlate with each other. And the Tax Act basically states if you want to receive your benefit because you're releasing it under permanent incapacity, then you need to get those 2 legally qualified medical practitioners to make that certification. So in other words, to have your benefit taxed concessionally, you need to go and get that medical advice. And I think then that takes away the idea of anyone claiming permanent capacity and then trying to withdraw a benefit out of the superannuation fund. Because if somebody does that and they pull their benefit out and say, okay, well, I haven't got the 2 legally qualified medical practitioners signing off on it, but I am permanently incapacitated, right? And they pull their benefits out and they pay their 22% tax on the benefit because they're under preservation age, for example. Well, then quite rightly, I suspect in that instance, the auditor is going to go, is this a legitimate condition of release? Where's your proof that you've satisfied the permanent incapacity requirement? The trustee says, well, I just think I'm permanently incapacitated. Of course, I'm drawing a fairly long bow here, but the trustee thinks down that path. So the auditor would lodge some form of contravention, go to the tax office. The tax office will investigate. The tax office will say, well, you're not permanently incapacitated. You've released your money as you've breached the preservation rules. And so therefore that's going to be taxed at your effectively your marginal tax rate. And whether there's any other penalties associated or a requirement to pay it back in, that's going to be a judgment in line with whatever the tax office determined at the time. So meeting that definition of a super disability benefit is the key to accessing money from a permanent incapacity point of view. When we pay that superannuation disability benefit, Rob, there's 2 ways we can pay it. We can pay it as a lump sum, and when we pay it as a lump sum, it results in the model tax-free amount. So again, subject to the age of the individual, that can actually have quite a substantial benefit in determining how much of the component is tax-free and how much of it's going to be taxable. Alternatively, if we pay that benefit as a pension, then we don't modify the components of the fund, but similarly to say a death benefit income stream that is paid to someone under the age of 60, we get our 15% rebate. So there is a tax offset associated with the pension. So in theory, there's a strategic concept there of, do you look at from a disability point of view, taking out a lump sum and then getting the tax-free or the reassessment of the tax-free amount, recontributing the amount, maybe that's a possibility, subject total, super balance, whatever, then restating that you've met the condition of release and then accessing the benefit as a superannuation income stream. Critical part of that is that if you access your money via a superannuation income stream, it will be measured against your transfer balance cap. So, you know, that's there's a timing issue there with regards to what members or how members act. Now, again, you know, just thinking about where we are, we're sitting in February at the moment, and we know or we expect the transfer balance cap to index to $1.9 million from 1 July 2023 versus $1.7 million now. Well, because there is no urgency from a payment of benefit from a permanent incapacity point of view, you know, there also may be some logic in holding off from the commencement, as you would consider with any other income stream payable or needing to be considered to be paid over the next 5 to 6 months. Is there benefit in holding off? But again, that's a whole another conversation for another day. How do we do that modified tax-free calculation? Well, basically what we do is we times the amount of we take the amount of the benefit, we look at our days to retirement, which is our days from the day we stop being capable of being gainfully employed up to our last retirement day, which is our 65th birthday. And then we multiply that by our service days plus our days to retirement. And you know, service days is one of those great old things that most of us don't give a lot of thought to it now that we don't have pre-83 and post-83 components making up a member's benefit. But eligible service periods are very significant when it comes to all of these insurance-based benefits that we need to be mindful of. So let's have a look at an example of Kate. And so I've just put some rough numbers really just to show you the overall benefits associated with these sorts of transactions and what you might be able to take away from it when contemplating it for your own particular clients. And of course, you can chuck in whatever sorts of numbers you need to there. So target retirement age is age 65. Kate is just shy of 50, so 48 this year. Ceased work in September 2022, has $200,000 in superannuation, $100,000 of that is tax-free, and then a $200,000 death and TPD insurance policy. So the first thing that we have to do based on that calculation, we have to work out with any benefit payment that we do, we have to work out what is the tax-free proportion of our accumulation interest, right? So we have to know how much is tax-free and how much is taxable. So in this instance, the tax-free portion of the benefit is 100,000 divided by the total benefit is 400,000, makes it 25%, right? So we add the super component to the insurance to get the total benefit there, and we know that it's 25%. Why do we do that? Well, if we're not planning on taking the full amount out, then we apply that 25% to whatever benefit we're drawing to determine what the tax-free component is. In this example, I've kept it relatively simple, and we're going to pull out the full 400,000. It gives us $100,000 tax-free. So then we take our 400,000 times by our days to retirement over our service days plus days to retirement. So our modified tax-free amount calculation is the 400,000 times by that divisible sum equals $178,000. We then add that to our existing tax-free amount, so the existing $100,000, to give us a total tax-free amount of $278,276. So that is significant, right? So here we are talking about someone who is 48 years of age, or roughly in that sub 50 age bracket, and we are more than doubling their tax-free amount of the benefit. So our taxed amount is the balance of the sum. So 400 less that 278 gives us 121. We tax that at 22%, which is our tax rate on lump sum withdrawals, less our, because we met the condition of release, less the or plus the Medicare levy, gives us tax payable of $26,780. If Kate did not apply or did not undertake this modified disability super benefit, then tax on that $400,000 would be $66,000. So we're ultimately saving $40,000 in tax just by applying that formula. So it's a fairly worthwhile exercise for Kate to be undertaking, and for us to be undertaking that calculation for and on behalf of our clients. Now, I'm going to come back to Kate in a moment, but let's talk about the future liability to pay benefits, because this deduction is basically stepped out in the following points. So the fund has an entitlement to a deduction if a member dies or becomes disabled prior to their last retirement date, and the fund pays a benefit as a consequence of the termination of employment. So this 295,470 deduction is accessible for death benefits, terminal medical condition benefits, permanent incapacity or permanent disability benefits, and temporary incapacity benefits. Would you claim it for temporary incapacity? Not in a million years, right? There'd be no, no one could convince me, right? Maybe someone could convince me if I've given up in my need to be convinced, but there's no reason to do it in the sense of a temporary incapacity point of view. However, from a terminal medical condition, from a death benefit, and from a permanent incapacity, then we should be looking at this. We should be looking at this to see whether there is any legitimacy to claiming this deduction in the fund. To claim the deduction, the fund must make an election prior to lodging its return in the year of the payment under the premium-based deduction section. So we can claim the premium under section 295,465, or we can make an election not to claim a deduction for the premium paid. Now, this is an interesting one, because I mentioned before monthly versus annual in that situation. Well, if Kate's benefit is paid and the insurance is ceased, but she pays her premiums annually and hasn't paid the premium during this year that the benefit is paid out to her, then she wouldn't be eligible to be able to claim the deduction under this section, because under the future liability to pay the benefit, because she's not electing to claim this over the other one. So, this is where monthly insurance or quarterly insurance premiums or whatever certainly have a greater benefit to the fund, because you've at least started to pay it out in the year, And really, only those that haven't paid it in, say, the first few days of the year, and somebody dies early in July, then they're going to be in that unfortunate situation. Once you make the above election, you cannot elect to switch back to other deductions for future years without the consent of the commissioner. So that's why before I highlighted this deduction as being largely a deduction that works favourably for self-managed superannuation funds, because your APRA-based funds are not going to deny themselves future premium-based deductions for all of their insurance, which is effectively mandatory for every one of their members. They're not going to do it for the sake of one benefit payment to a member. And the excess deduction can be carried forward as a tax loss. The way that the calculation is done is it's the benefit amount times our future service days divided by the total super service days. The benefit amount is on the entirety of the lump sum. So insurance, non-concessional, all those elements are taken into consideration. And our future service days is a days from date of termination of employment to the date of last retirement, again, our 65th birthday. So again, it's a moot point once somebody turns 65, because the calculation will not work favourably after that point in time. But if we look at Kate situation, and Kate took $400,000 out, then there's a future liability to pay a benefit deduction of $178,276. So if we work the sum out on the 400,000, we use the formula as appropriate, then this fund gets a tax deduction of $178,276. Now, if we go back and say, well, what's the purpose if Kate's taken the entirety of her benefit out? Well, let's say that Kate has a spouse. Let's say Kate has kids in the fund and they're all contributing to the fund. Well, $178,000 is a lot of income to be generating to be able to offset it with a future tax deduction like this. So there is a huge potential benefit from a fund, particularly on a disability benefit there, but also on death, to be able to provide for a very strong tax position for the fund moving forward. But I come back, you've got to have that consequence of termination of employment, right? So you effectively, your death or disablement had to result in you ceasing work. Of course, death is going to result in you ceasing work, but your condition had to result in you ceasing work, and you had to have had a premium that you would otherwise have claimed under the 295465 section. So a pretty significant situation. And look, to work it through, and this is just to give you a further example of it under a death benefit scenario. And again, we've got Bill here, date of birth. Bill's a little bit younger than Kate was. Bill's married, got a child who's 19, is an employee, and $500,000 of superannuation. So again, if we look to apply the calculation to Bill, then on a $500,000 benefit payment, we're creating a tax deduction of roughly $263,000. Now, this deduction is seriously good for those who got, I guess their time in superannuation is either they've got a long way to go till 65, or they've just set up their self-managed superannuation fund, and so their current days versus their future days is disproportionately advantageous from a future period here. So the longer sort of future period you've got, or the shorter existing service period you've got, then the better this deduction is going to turn out for your fund. But again, as I've stated at the bottom here, this amount can be used for future capital gains tax, concessional contributions tax, so the 15%, and other taxable income. So it is a really beneficial deduction, subject to a really terrible situation occurring. But going back to what I highlighted earlier, and that is that you don't need to explain this deduction to a client until an event occurs. So what you do need to have conversations with clients about is whether or not they should be considering insurance. And when you're having those conversations, you can say, well, the purposes of having insurance is to, one, help you fund liabilities or whatever outside of super. But if you hold those insurance policies inside super, they are deductible. The pros of that are if it's deductible, then you're offsetting the tax of the fund. If the benefit's paid to a spouse, then there's going to be still a tax-free death benefit. If it's paid to an adult child, there's going to be an untaxed element. We need to be mindful of that. We'll go through that in a sec. However, there's also other deductions that could arise subject to when an event occurs in your life. So you don't have to cover off on this necessarily, but you need to know about this so that that people can potentially utilise it in the future. So let's look at that untaxed element, and then we'll tidy out and round out the presentation talking about a number of the other key issues associated with insurance in the fund. So if you've got a death benefit where a deduction has been or is to be claimed under either the premium-based deduction or the future liability to pay a benefit deduction, then you are required to do a calculation of an untaxed element if paid to a non-dependent. Now, in theory, you could do the calculation every time that you pay a benefit out, but the tax rate payable to a spouse is nil, so there's no point doing it there. And the tax rate paying out to a dependent child will always be just a taxed element if the deceased was over the age of 65. So, it's one of those calculations, again, where if you've got a single member fund and they are wishing to pay their benefits out to non-tax dependents, then arguably there's a reason to say, well, it's not in the fund's best interest to hold the insurance, not in the beneficiary's interest to hold the insurance inside of super, because yes, the fund gets a deduction, but they're going to have this untaxed element on the end insurance payment, which they're not going to get if the money's held outside of super. So we often look at superannuation and tax on a year-by-year tax return basis, or with these sorts of considerations, it's really over the lifetime and the expectation of where benefits are going to be paid. Now, of course, we can't predict in the future in a family-based fund whether spouses will die before the other spouse, whether the children will be adults or not, whether or not they'll still have insurance, whether they're under or over 65. So, it's one of those things that, again, we just need to be wary of. But what we have to do in every set of circumstances is do our normal tax-free and taxable calculation, and then on our taxable component, we have to determine both the element taxed in the fund and the element untaxed in the fund, and we do that by applying that formula. So these are all these formulas, as I said before, are all service days based. So it's why it's important to understand the concept of service days, and it's why it's important to recognise that if you set up a self-managed super fund, then the service date of that fund is the day that you join that fund. If you roll money over from an existing fund, then the service day is going to be the rollover date, the earliest date, so the date potentially on the rollover. So, service days are factually driven, but can ultimately be different if you have two different funds. So you could have your fund that your employer contributions are going into over in an industry fund or something else, or an old employer sponsor fund. That might have a longer service period, and then you have a self-managed super fund which has your personal contributions, and that's not linked necessarily to that other fund. It's going to have a shorter service period. So it's important to understand that. So if we revisit Bill's circumstances again, then we know that we've got the $300,000 with $200 tax-free, and then $200,000 worth of insurance proceeds. Our taxable component is $300, our tax-free component is $200. That's a relatively simple calculation for us to do. Our element taxed in the fund is going to be, and I've used years here. One thing I should have said before with the future liability calculation is when you're doing these calculations, you've got to use the actual number of days. So I've just used years just to highlight the principle of the calculation, but you've got to use the number of days. So the element taxed is $500,000 times our 18 years over our 38 years. Gives us 236,842. We take off our tax-free amount, which gives us 36,842, meaning our taxed element, our element tax, is 36,842 at 17%, which gives us just over $6,000 tax. Our untaxed element is the taxable component less the element taxed, which is 263,000 at 32%, which is 84,210. So that's a fair sting in the tail in the instance of paying out a benefit to the adult child. And so this is one of those situations where clearly the advice would be to pay out to Bill's spouse. But it's one of those sort of sets of circumstances where we need to make sure that they understand the ramifications of paying out to a non-tax dependent. So they're the taxation or the main or the primary taxation things to be mindful of when we're dealing with insurance and holding insurance in the fund. One, that it's deductible based on death, terminal condition, temporary and permanent incapacity. Two, you can hold it if it's any of those four things in the superannuation fund. Thirdly, that there are deductions that are better than other deductions in circumstances that are worse than other circumstances. And then there is the hidden tax being the untaxed element. But I will say this, in however many years, and I'm losing count these days, so let's just go with 25 years of doing SMSF administration work, I think I've calculated one untaxed element. Now, I've clearly spent more time in this presentation today to you dealing with untaxed element than I have in the administration space, but the number of death benefits that you will come across in your life that you pay to a non-dependent where the deceased was under 65 and had insurance that they've claimed a deduction on is going to be fairly small, but you don't want to get it wrong when you have that. And so, you know, that's the key point to talking through these issues, particularly given that insurance is a requirement to be considered, and particularly given we're now seeing self-managed super funds being set up at much younger ages. And so people's default will be to look at when they need to have insurance in their fund, and that's likely to be when they start to have mortgages or whatever else is associated with it. And so therefore, you know, we're going to have a greater percentage of SMSFs holding insurance than we've seen historically. And I think that that's something to be mindful of. So when we look at the other considerations around insurance, the first one that I would touch on, which should almost be the last one I'll touch on, but I like to talk about pensions and insurance. So insurance proceeds are proportioned based on the member's interest. So if you have an accumulation interest, and ultimately what this means is that when you pay insurance premiums, you need to identify where they're coming from. So if you've got members with accumulation interests and pension interests, then largely people are going to withhold the insurance premium from the accumulation interest because that is the taxed interest. And so it serves a better tax position for the fund. When those monies come into that accumulation interest, then the insurance proceeds will be considered 100% taxable component. You go through all those examples and calculations that we just did then. If you've got an income stream, then basically the money coming in, it's income. It's effectively a return on an investment, the investment being the insurance policy. Then that income comes into the fund and is attributable proportionally based on the commencement proportions of tax-free and taxable to the fund. So it might be broken down between tax-free and taxable, subject to how that income stream is set out. Taking that a step further, if we look at the transfer balance cap, and I highlighted this before very early on in the presentation, is that in a reversionary pension sense, right, when the member passes away, from a transfer balance account point of view, whatever the balance is on that day, that's what's represented for insurance purposes. Now, that's what's represented for transfer balance account purposes. Now, the fact is, even though it's reported in 12 months' time, sometime in that 12-month cycle, the insurance proceeds are going to be paid into the fund, but they're not going to be added to the transfer balance account. So that's quite a positive, in the sense that the fund will then get the exempt current pension income. The flip side of that is how many pension funds that are pure straight grade retirement phase pension funds will hold insurance proceeds. Slightly different if we're talking about a TRIS, and of course a TRIS can be reversionary, so we might see more circumstances of a TRIS holding insurance proceeds, and that can of course revert to the spouse, so there might be some benefits there. But largely for our members that are in reversionary pensions, it's not going to be the case. Versus a discretionary pension, so death benefit that's subject to a binding death benefit nomination or to trustee discretion, we might determine to pay a death benefit income stream to that member. Well, in that set of circumstances, the insurance money comes into the fund, and that money comes into the fund, and then you start the pension, so therefore it's going to have a larger impact on the transfer balance account. If you try to argue and say, well, actually it was a pension originally and we're just paying a new pension, and so that amount forms part of that same interest, well, it's not going to be the case, because the way the transfer balance account works is you have to look at the account balance the day immediately before you commence the pension. And so therefore, in theory, if the insurance proceeds haven't come in and you start a pension, then when those insurance proceeds come in, they're ultimately going into a new accumulation interest, because that old death benefit interest no longer exists. So going into an accumulation interest, and would then either have to go across under the transfer balance account if they're under their personal transfer balance cap, or be paid out under the normal death benefit rule. So just being mindful of how that operates. And then the other side of it is specifically for discretionary pensions, is we know that the exempt current pension income deduction continues on the income earned on the deceased member's benefit up until the death benefit is paid, whether that benefit's paid as a lump sum or as a new death benefit income stream. Any earnings on the insurance proceeds that come into that fund are not subject to the ECPI. So we need to understand that if there is some long process before starting a death benefit income stream and insurance proceeds have hit the fund, and then there's earnings generated on those insurance proceeds, those amounts would not be subject to the exempt current pension income deduction. So again, how many funds would that happen to? We've got special instructions about that, but how many funds would that happen to? You would think relatively small. Pre-1 July 2014 insurance. So I did mention in the brief about today's webinar that the insurance rules ultimately changed in 2014. They actually changed in about 2009, but it took 5 years almost for the commissioner and the industry to really get a hold of all of this. It might have been 2011, but it took a long period of time for certainty and a position to be reached. And ultimately, what it meant was a lot of funds had own occupation TPD, which do not meet the definition of a disability superannuation benefit under the Tax Act. And a lot of people had trauma insurance inside the fund. Now, the ATO have maintained the same position forever on trauma, and that was certainly before 2014, that it wasn't prohibited from being held in super, but if the level of premiums you were paying was ultimately fairly significant, then were you in breach of the sole purpose test, given that trauma wasn't a condition of release, and that money would subsequently just be stuck in the superannuation fund. So trauma was always a weird one, because there was really no tax benefit inside the fund to having it, and there was also no condition of release to be able to access the money anyhow. So any pre-existing 1 July 14 TPD and trauma policies can be retained inside super. I suspect now that we're 8 years down the track, most of them have disappeared or been moved outside of the superannuation environment, albeit that some of those own occupation ones are marginally deductible or proportionally deductible. And there's specific regulations about that. And then you've got self-insurance, and self-insurance was, again, a little bit like anti-detriment. It was a way to be able to manufacture deductions, such as the future liability to pay a deduction, but rather than, and often were used by people who potentially were not insurable elsewhere. The purpose was to take earnings of the fund and allocate them to reserve for the purposes of insurance, to pay out a benefit, and to obtain an actuarially derived tax deduction each year. Basically, since 2016, we can no longer use these insurance or self-insurance inside a self-managed fund. And as I highlighted with the anti-detriment, ultimately these amounts now are general reserve. Other investment-based insurance, well, clearly we've got our collectible and personal use assets, and under SysReg 1318 AA, if we hold a Section 62A item, so our artwork, our jewellery, our wine, various collections, whatever, motor cars, if we insure that, or not if we insure that item, if we acquire collectible and personal use assets, then we must insure those assets in the name of the superannuation fund. And if we don't do that within 7 days, then we're subject to SIS penalties, and that penalty unit is 10 units, which is $27.50. Arguably, it's pretty difficult to get insurance for a lot of these assets. So you really, from a superannuation point of view, again, the whole purpose, and also a totally separate presentation on collectible and personal use assets. But are you investing in these investments because personal enjoyment because you love it, or because you actually see great value. So from a retirement investment point of, or retirement income point of view, you're going to be able to generate a great income by investing in them inside your fund. But either way, you need to insure these assets. So that can be problematic. What about other insurance that you might hold? Well, property investments, clearly, if you've got a property inside a fund, then you're going to have different property or different potential investment, different insurance policies held against that property. That's a general fund expense. Audit insurance, you'll see a lot of different places promoting audit insurance, and it is a legitimate form of insurance. It is a deductible expense to the fund to hold it. But probably the bigger or better question to ask in regards to audit insurance is what cost is there to your fund if your fund is audited by the regulator? So talking with your administrator, talking with your accountants, your auditors, what sort of collection and maintenance costs are associated with preparing that fund for the audit, and how much is the premium versus how much is that cost? Is it worth it to be able to claim it back? So it's one of those other sorts of elements of insurance that people need to be mindful of. So in summary, what I will say based on other considerations is, if we look at 2017 super reform, now that death benefits can be rolled over, that concept of the future liability to pay a benefit deduction is pretty significant, in the sense that before, when you had the member in the fund, there are very, very restricted capabilities to roll their pension out of the self-managed superannuation fund from a timing point of view. But now, if you've got other members in the fund, accumulation members, then you can maximise the benefit of any future liability deduction by moving the exempt income potentially to another fund. So, just strategically, there are certainly certain opportunities. Similarly, with terminal illness, we've got non-assessable income to the member, so we can have money coming in. We can pay a terminal illness benefit out to the fund, to the member. We can claim that deduction, but then the member has other benefits inside the fund, and we can still offset the future tax liability of the fund by making that future liability to claim benefit deduction. So, there's a lot of strategic things that go into these areas for us to consider, and I've really only just touched on a number of them today. So, look, thanks for attending today's webinar. We're at the moment we're putting together the program up till 30 June, so dates and subject matters. So we'll be releasing the information on upcoming webinars shortly. As I said, you'll get a copy of the slides today with your CPD, and we will issue that out to you by the end of this week. So thanks for joining me, and unless anyone's got any further questions, we will shut off the webinar.